Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, it's our series on life insurance audits, and on today's show, rating services and carrier balance sheets. And with me today is CPA Richard Newman. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to the show, Richard.
Thanks, Steve.
Well, we're talking about ratings, and I can hardly believe that a CPA, and you're so credentialed with so many credentials, but CPAs are very interested in the ratings of a carrier. And I mean, we have 6 major rating services. There are a few other ones. They usually measure either financial stability or claims paying ability, which I've always found to be kind of similar. So let's talk about this, because when I'm looking at ratings, I mean, a AAA versus a AAA versus, I mean, Moody's, S&P, Fitch, AM Best, Weiss, Comdex, they're not all the same numbers. Their AAA is not equivalent.
Comdex seems to kind of amalgamate everything and kind of give you an overall perspective where the insurance carrier fits in the rating services. But I think it's very, very important to understand what the ratings are and what they have been. Are they going? Which direction are they going? Remember, you're buying life insurance. Life insurance is not a purchase. While it should be reviewed, as we talk all the time, it doesn't mean it should be changed all the time. And life insurance is a purchase that's going to be with you for 10, 20, 30, 40, 50, 60 years maybe. You think you'd want to buy the right company at the time.
So the contract's only as good as the carrier behind it.
Exactly.
Well, Richard, I'm looking at this, and I just spreadsheeted AM Best, Standard & Poor's, Moody's, Fitch rating, and then Weiss, and then, of course, the numerical Comdex. Just to letter ratings for a moment. I've noticed that an AM Best A+ is their second level, highest level, but an A+ on Standard & Poor's is the 5th level, whereas the Moody's A+, right, their A rating is down to 5 ratings. The A+ rating for Fitch is ranked 5th. They're not all equivalent. And this is where we get into this thing where people default back to their CPA or the fiduciaries and say, guys, is an A+ in school when we grew up sounded pretty good.
If I had gotten A+ across the board, my parents would have been very, very happy. I guess I was somewhere in the middle of the pack there until I got to college. But no, I agree. It's confusing for the consumer out there as to what should I do, what should I buy, and then you have the career carriers who are only trying to sell their product all the time, and putting to shame companies whose ratings may be slightly less than those. That doesn't mean that client, that company's going to go out of business. If you're buying a product that is a commodity type of product, like a term product that you're not going to convert, you want the cheapest possible product. So do you have to go to the best company in the world to buy a product that's a commodity product that you go to not even a second-tier company, just to drop down, you may save 30-40% in that. So the ratings are real important, but also take a look at what you're buying and how long you're going to have it. And the history of that company, and is that company going to be there? So I think looking at the ratings is not the only place we look. But I think, to me, I look at the ratings a little differently than most people do. In one of our other conversations, we had a discussion about some of the variables in a life insurance contract. And is the company going to decrease the dividend rate on you? Are they going to decrease the interest crediting rate? Are they going to start to increase mortality expenses on you? My experience in the life insurance industry for 23 years now is that companies are not really going out of business. And historically, nobody's really ever lost a dime of death benefit. The other carriers have come to their aid. Doesn't mean they're going to do it in the future. But my concern is, would an inferior company, if they're not doing well and they have the ability, if they're not doing as well as another company, pass some of their mistakes on to their consumers in the form of reduced dividend rates, reduced interest rates, increased mortality expenses in that portion of the contract. So my concern is, yes, I'm concerned about the carrier being in business when that time comes to write the check. On the other hand, I'm also involved with my clients as they live and want to limit what the costs are for their life insurance. Again, as my clients age, and I think I'm as guilty of this as everybody else, is we want things to stay the same. We want consistency in our lives as we age. You know, when we were younger, we could accept a little bit more leeway in things. But as my clients age or on fixed incomes, they want to know that the cost of their life insurance is X. It's not going to be X plus 10%, 20%, or 30%. And I think looking at the ratings gives us a little bit of indication there about how a client will be treated down the road. But again, past performance is no indication of future performance.
No, including our history. I mean, we've been a very good industry of trying to help other failing companies so that our name is not besmirched in the financial community. But that's still no guarantee of future performance.
And we're at a time in a world that has never been around for insurance companies in the past, this low interest rate environment. So again, looking at the ratings is hugely important.
I've noticed that every rating service has their own definition. It's so funny. They say strong, superiors, great strength. I've learned over my years, especially because I write so many articles and so forth, to actually ditto whatever they say. I quote them. I don't say, I think this company is strong. Or I say what the ratings say. Give them all 6 rating services to look at. Now, you mentioned Comdex earlier because it's kind of like the potpourri. We kind of made a weighted value, made a numerical weighted value, and assigned it. There's not many carriers that are 100, but there's a lot of carriers in the 90s. When we come back, we're going to continue our addressing rating services, and we're going to talk a little bit about carrier balance sheets as part of your overall business strategy that can position your practice as the premier provider of product information. Hey, not only to the fiduciary market, but also use this as a prospecting tactic for new clients in your community. And you can request your own life insurance audit on your own clients at downtobusiness.ashbrokerage.com. Just fill out the request form. And don't forget, while you're out online, go ahead and sign up for the 30-day free trial offer for Backroom Technician. Just go to brt.com/trialsignup.aspx. We'll be right back. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back. I'm Steve Savant with Richard Newman. And remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, right out at ashbrokerage.com. Just click on the show logo, take you right out to the homepage. And just a heads up, before moving forward with any of the ideas on our show, always talk to your tax advisor or legal counsel, as well as your broker-dealer compliance officer. Well, we're getting down to business now, and we're talking about some of the compliant issues of ratings, but also we're talking about balance sheets, this is really up your wheelhouse. I mean, we're talking
From
about
a long time ago,
Yeah,
but you know,
yeah.
but I still know how to read them.
You still know how to read them. And what's the real interesting, back in the day, this is back in the Steve Savant early days, when we looked at ratings of carriers, we were also looking at their balance sheet. One of the things you said in the first segment, really, which is why I'm bringing this up, is because sometimes the ratings don't say everything I need to know. And I might be penalizing a carrier because they're a notch below somebody else. And we're talking about a difference in premium, maybe $20,000, $30,000 a year.
Oh, it could be very significant.
Yes, it could be significant. So when I'm looking at this, I'm looking at the convention blank. Every carrier has to file with every state, and they call it the convention blank. If you haven't seen this as a producer, really, you haven't lived yet. It's a big ledger, blue, it's monster, and on page 28B and 28A and B, you see all the investment portfolio. And back in the day, when we used to look at junk bonds and default to real estate, we were all over those pages looking at every carrier. But now, all this has been modernized, and it's been reduced down into a summary sheet. When I'm looking at, strictly as a CPA now, I'm looking at areas. I got my ratings, know what I want to do, but now I'm looking at size. What's the total assets? How big is the surplus and AVR, asset valuation reserve? Do you look at that when you're into the bigger philanthropic cases, the big estate cases? Do these kind of things matter? Big, size, net worth?
I think our clients are pretty much looking at the rating services out there. They're kind of depending upon us to ensure that we go to the right carrier. And you know, when you're getting at size and bigness, remember most of the insurance for most of the insurance companies, they're laying off the risks on reinsurance companies, and so the bigness comes from the standpoint of a life insurance company's capacity. And when a capacity issue in that circumstance takes place, and I have a really good underwriting, a superior underwriting, medical underwriting category for a client, and I don't have to take that client out to reinsurance, I may be able to get a significantly better deal in that vein because the company is coming in and helping support that risk. That company may look at that risk differently than the issuing company does. So again, in terms of size, I look at that in terms of capacity. If I got $1 million or $2 million type of a placement, that usually is not a big issue. When you're talking to tens and 20s and $30 million type of capacity issues is whether life insurance is on somebody. So that's where the balance sheets really start to come in the size of the company.
Well, I looked at, and they show this report, which is a 4-page carrier profile, financial profile, actually talks about what's seated outside. So if the carriers has a pretty substantial, and some of the big blue chip East Coast carriers have huge retention, 20, 30 million for one person.
Huge.
I mean, they're monsters. And sometimes they have to, for the large cases, punt and go out to their automatic reinsurance treaties.
Correct.
And then once in a while, we have to drift into facultative, which is, of course, I don't want to go there if I don't have to.
Exactly.
Now, when we're looking at this, when I look at the assets, most of our carriers that are creme de la creme, highly rated, are sitting with investment grade bonds, government bonds, class 1 and 2. Very little. You're not seeing a lot of carriers anymore. They're playing in the big leagues with really, I'm calling quality bond government debentures.
Exactly.
Talk a little bit about that, because I think a lot of people don't understand that that's where our ratings come from, and a lot of our portfolio is coming from that. We're not a risky bunch.
Oh no, the life insurance industry is really a significantly more conservative group of people than a private equity fund that may be out there in the marketplace, and you can't really compare the two from that vein. But understanding what the insurance carrier is purchasing and what does their investment portfolio look like allows to deal with what the risk, the long-term risk in that portfolio would be. On the other hand, when they're that conservative, the earnings on the balance sheet are going to be extremely depressed. And again, so that's the conundrum that a life insurance company has, especially those that have written quite a bit of either annuities that have significant guarantees in those, or other life insurance products that have higher guarantees of interest. In a universal life product, there's a minimum rate of return that has to be paid on a cash value. That rate in older contracts is 5, maybe 6%. Today it's 2% in the contracts that are out there. So it's from that standpoint, that's really the conundrum that a life insurance company is dealing with today. How do I get the rates and how do I get the returns without increasing the risk in my investment portfolio?
Well, when you look at us from an industry point of view, and I'm just going to take the top 100 carriers, which write about 85% of everything that's out there on the life insurance market. I'm looking at defaulted junk bonds, defaulted real estate, defaulted mortgages. I mean, they're just not there. I mean, it's a very small percentage.
Exactly.
And so when we're looking at conservatism, we're looking at balance sheets. They don't call some of these big mutual carriers blue chip companies for nothing.
Right.
They really have strength. When I'm looking at this, I was looking at some other areas of the balance sheet, and I'm looking at earnings. A carrier actually turning anything over 6-7% right now looks pretty good.
Oh, it's great.
I mean, I can't believe these guys are knocking out these numbers. Now, I have a question for you though. What happens if we start to get increasing rates? Because people say certain products will do better in an increasing interest rate environment than other products.
They will. The guaranteed products will perform significantly better there. They require significant amounts of reserves. And those reserves have to earn something. And if it's not earning anything, the cost of the product goes up.
Well, that's our show for today. Don't forget to read my online insurance commentary, my advisor blogs, and my articles on Producers Web, as well as my answers to consumer questions on the Insurance Library. And remember, you can view all our past episodes on our on-demand section at downtobusiness.ashbrokerage.com. So follow me on Twitter, Facebook, LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'll see you tomorrow.